Good morning, everyone. It's Remon Vos speaking from Prague with an update on the first 9 months of 2024. Has been good, and we continue to see strong operational and financial performance. So this year has been good so far. I expect also Q4 to be very strong. We are working on a number of deals which we hope to close before year end. Core business, City Park network, full service business parks, and which we continue to extend and grow, mostly with existing tenants. Tenants are happy. They continue to extend their business. And when looking at new deals, approximately 2/3 of all new lease agreements are being signed with existing tenants, which is good, in line with our target. We've done more than 1.5 million square meter of leases so far this year in 2024, and that's up almost around 5% compared to the 2023 number. And as I said, looking forward to Q4 seems to be, or promising to be, a good quarter for us also in terms of take up. And with that, CTP remains market leader in most of the CEE countries, so the four countries where we started: Czech, Slovakia, Hungary, and Romania, but also market leading in Serbia, and also quite positive about the Polish market. Also, I've seen some take up in Amsterdam at our City Park Amsterdam project in the harbor of Amsterdam, which is very positive. A couple of leases signed. Yeah, demand comes from existing clients, as explained, mostly CEE as a business smart location in Europe. It has been, but also nowadays, when there's a bit more pressure on cost, you see more companies moving to Central Europe. Labor cost is not the only thing. It's also productivity, it's the location, the newly developed infrastructure, and also definitely the culture, the overall business smart attitude, I think also from local governments, etc., which we enjoy here in Central Europe, which makes many companies successful and continue to grow in this part of the world. Some of our clients come from Asia. I just returned from a 10-day trip. I've been to, obviously, to see our Taiwanese clients in Taipei. They're involved in semiconductor business. We are doing multiple projects for them in the Czech Republic, but also in other countries, in Germany, for instance. Also met many of our Chinese clients who decided to bring more activity to Europe. It's in Europe for Europe, so they de-risk their footprint or supply chain, also decarbonize, and need to be in Europe for their European business. And there's all type of different industries which we see come from Asia to set up business here in Central Europe for the European market. And that is also because of geopolitical and other reasons, and that is a trend which we believe will continue. Defense industry is another driver, but also we see demand coming from the consumer, FMCG or fashion retailers, which we do a number of projects for. Out of Bucharest, you can now supply the region, which includes Greece, which includes part of Turkey, Bulgaria, Serbia. So I think business smart also means well-developed infrastructure, road networks, etc., etc. I mentioned automotive also because of Asian companies coming to Central Europe for automotive. They follow big car makers like Volvo, who are doing a 1-point-something billion project in East Slovakia. BMW, who are building a factory in Hungary and invest more than 2 billion euro, and also Volkswagen. Their best plant, as they say themselves, is in Bratislava, Slovakia, and they recently invested more than €1 billion. We are involved in those big projects. We are involved in helping to accommodate some of the suppliers. If you look at automotive, our exposure, I think, is around 20%. The past 12 months, I think, the amount of leases we signed related to automotive are a bit down. I think 16%, 1/6. The companies involved in automotive industry for us also means aftermarket. So you have companies who store tires. We have Bridgestone, Continental, Pirelli. We have a couple of them in different parks. Brake pad producers also for aftermarket. That was all what we think is automotive. We don't have any engine producers or something like that, or gearbox producers in our portfolio, but we do have companies who produce interiors, car interiors, for example, airbags or dashboard or even car seats. Yeah, we have them and they're quite successful. They like to be close to where the big car makers are. And we continue to see a trend, business smart, which also means from more expensive countries moving into Central European region. We have seen that before. As I said, just returned from Asia. Also, if you look at the technology and the autonomous driving and the different car makers and the electrical cars, etc., there is fantastic and huge opportunities in that industry because of the change. And I think CTP will continue to benefit from all of that extra demand coming from this change going forward. Before I hand over to Maarten, summarize shortly our business lines. Operator, of course, is the income producing part of the business. Good quality buildings, which we work hard to keep them in an excellent condition, all BREEAM certified. Operator is good. We continue to add solar panels on the rooftops, and we've been able to grow till almost 13 million square meter of lettable area, which is good for 700 million euro of rental income per year, with many different businesses and companies in those properties. Tenants, I mean, more than 1,000 blue chip tenants from all over the world involved in all different range of industries. That's one. Then the developer, mostly, of course, continue to build land, which we have in existing business parks. So land with infrastructure permits, etc. And those projects are being done by local teams on site, project managers, etc., construction teams. And they continue to build properties in different sizes, extensions, but also new developments and new projects for new companies, which is also very important, because keeping your existing tenants happy is one thing, but acquiring new business is also another thing, which is very interesting. We are working hard on that. Which often comes through the ecosystem, people we know. The developer, almost 2 million square meter under construction, 75% of that in existing business park. When we lease that up, there will be another 140 million euro of rental income. And we are continuously leasing up the space which we have under construction. There's some pre-leases. We are leasing while we build, as you know. Yield on cost continue to be north of 10%. And we expect upon completion that we be at 80-90% occupancy when these buildings are complete. That's for the developer. I mentioned solar, 120 megawatt installed by year end. This doesn't mean that everything is operational. Sometimes it takes time to get all the permits in place and to start producing energy. Installing rooftop solar plants is one thing. We do that. At the same time, we install smart metering systems, so we know exactly in a business park what different tenants consume at what time of the day. So we do energy management. So also we then know better if we produce solar energy, then when do we use it, where do we use it, when do we sell it, to improve efficiency, but also obviously to look at results and how we can run that business in a better way. That's happening at the same time. So happy to answer any of your questions. I think for now I'll just hand over to Maarten and Richard later. Thanks for joining and your support. Thank you.
Moving on to our financial highlights. The like-for-like rental growth came to 4.4% in the first 9 months of 2024, driven by indexation and strong rent reversion. Occupancy at the quarter end remained stable, while the reversionary potential now stands at 15.1%. And we have proven to be successful in capturing this potential for the leases that came up for expiry. Our gross rental income for the period increased by 15.9% year-on-year to 488.4 million euros. The net rental income went up by 18.3% year-on-year as we reduced our service charge leakage. Consequently, the NRI to GRI ratio came to 97.4% in the first 9 months. Annualized rental income increased to 702 million euros, illustrating the strong cash flow generation of our standing portfolio. and we target to reach an annualized rental income of 1 billion euros by 2027. The company's specific adjusted EPRA earnings per share increased by 11.7% year-on-year to 60 euro cents, on track to reach our guidance of 80 to 82 euro cents for the year. CTP's strategy is built upon long-term client relations, with around 2/3 of our developments taking place in existing parks for existing tenants. This de-risks our business model, as these are proven locations with existing tenant demand. And it feeds as well into our valuations and the huge opportunity we have with our 27.1 million square meter land bank. Assuming a 50% build-up ratio, we can build over 30 million square meter of lettable area on our current land bank, taking into account the average construction cost of 500 euro per square meter and land prices of 50 euro per square meter. The total investment cost for 1 square meter of GLA comes to 600 euros. This, while the standing portfolio, excluding the former Deutsche Industry REIT, is valued at 1,000 euro per square meter, which allows us to realize a potential development profit of 400 euro per square meter. This also enables us to continue to generate organic double-digit NTA growth, also in the years to come. Now looking at the valuation results. For the Q1 and Q3 results, only the investment properties under development are revalued. In the third quarter, the revaluation amounted to 167.4 million euros, driven by the leasing and construction progress on our developments. This brings the year-to-date revaluation to 604.1 million euros. CTP's reversionary yield stands at a conservative 7.2%. And looking ahead, after the 80 basis point increase we experienced in the last 2 years, we are at a clear inflection point for yields. And we do foresee further positive ERV growth in the Central and Eastern European region. In most CE markets, inflation-adjusted real rents remain lower than 15 years ago, illustrating the affordability of the region for our tenants, as well as the rental growth potential. Our EPRA net tangible asset per share increased from 15.92 euro at year-end 2023 to 17.52 euro as at 30th of September 2024, representing an increase of 10.1%. And now I hand over to Richard.
We have a robust balance sheet and strong access to multiple pools of capital. In 2024, we raised 300 million euros of equity through an ABB in September and 1.8 billion euros of debt, of which 1.3 billion euros was unsecured, with the remainder being secured. Over the past 12 months, we have made attractive, accretive acquisitions, particularly in Germany and in Romania. And we anticipate allocating the proceeds of the September equity raise into further accretive acquisitions over the next 12 months as we see transaction markets recovering across Europe. Our cash position stands at 1.3 billion euros, more than sufficient to meet our cash needs for the next 12 months. When including our RCF, our liquidity position amounts to 1.8 billion euros. The average maturity of our debt stands at 5 years, with no material debt maturities until June 2025. At the end of the third quarter, CTP's average cost of debt came to 2.7%. This will continue to tick up going forward as we bring on new funding at today's higher interest rates to finance our development-led growth. However, we have seen our marginal cost of financing come down during 2024. And depending on the maturity, this is now around 4%. Thanks to our strong cash-generating portfolio, we have a healthy interest coverage ratio of 2.75 times, while our normalized net debt to EBITDA reduced further to 9 times. As shown during our recent Capital Markets Day, thanks to our development yield on cost of over 10%, each euro we invest in our pipeline improves both our ICR and net debt to EBITDA ratios. Following our recent equity raise, our loan-to-value ratio is now back within our target range. Our LTV will come down further as our development pipeline is completed and the revaluation gains become fully booked. Looking ahead, We are confident in the outlook for CTP. We have a strong tenant lead list, and in addition to what we have already pre-let in our development pipeline, we have nearly 180,000 square meters pre-let for future projects where we have not yet started construction. We continue to see rental growth across our markets, as well as nearshoring speeding up in many industries. Our pipeline is highly profitable and tenant-led, and thanks to our industry-leading yield on cost of over 10%, we are able to deliver sustainable and profitable organic growth while maintaining our strong financial position. We confirm our EPS guidance of 80 to 82 cents for 2024 and expect to deliver 1.2 to 1.3 million square meters of developments this year, in line with our long-term growth targets. Thank you for your attention. We now welcome your questions.